And welcome to another edition of the VSA Capital All-in-One podcast. And today we've got Colin Harrington, the CEO of Zephyr Energy. Hi, Colin. How are you?
Hi, Andrew. Very well, thanks. How are you doing?
Yeah, not too bad. I'm actually in a very cold Toronto, and I've got obviously Ollie O'Donnell, who's still in a rather, guess it's probably damp London. Are you, Ollie?
Actually, it's clear blue skies.
Lovely, lovely. Hi, Ollie. Nice to see you.
Hi, Colin.
Hear
Thanks for
you at
joining.
least. Yeah. And Andrew, it has been a brutal winter for those northern states, and for obviously Canada is not the 51st state yet, but it's been a brutal winter up there for sure.
Well, you sort of led there into my first question, which is about Trump. Because, I mean, Trump's been saying, drill, baby, drill. And actually, of course, that's what you're doing, isn't it, Colin?
We are drilling, but thankfully it's not government mandated. Yeah, it's certainly interesting times over here, and as you know, Andrew, the U.S. is a great place to operate. It's really friendly from a taxation and regulation side of things. The country itself is producing more oil than any country in the history of the world. And that was under Biden and under Trump. We do expect that to continue, but there is no state oil company, and it's nice to have friendly regulations. But on the other hand, every company's capital allocation decisions are made by their boards and their investors, and we're still in an era where investors very much want to see dividends, return on capital, and are not interested in volumes; they're interested in cash flow. So, even with the encouragement of drill, baby, drill, I'm very positive about the level of capital discipline here and pricing overall. I think we're going to be in a good environment here soon.
Yeah, I mean, we've obviously talked before, and I think people know your model, but you have a model of producing assets that then can throw off cash for you to go and drill, so that you're in a sort of, you've got the two assets, one funding the other. Do you want to give a quick update on how the balance is for that?
Yeah, I mean, I think of our cash flowing assets as the foundation for something we're building in the paradox. The bigger the foundation, the larger the structure that we can build in Utah. So the cash flowing assets are about 220, 230 wells or interest in those wells in North Dakota and Montana in the Williston Basin. So really well-defined area, thousands of wells drilled over the last decade. These are all modern horizontal wells, between 1 and 3 mile long laterals. And it's a very low risk but high margin portfolio for us. And that gives us the cash flow to then invest in what we're doing in Utah, which is a much more, it's an immature play. It was really overlooked during the first phases of the shale boom, but is a place where we've had really interesting results so far, including on our latest drill. And we think that our overall goal is trying to open up the next great onshore U.S. oil and gas play. And I think we're close to being able to do that.
Yeah, and you have been drilling. How long you finished? I think it was a week ago or so. But how long were you drilling for, and what sort of drills did you do?
Yeah, so this was going into a well that had already been drilled down to the reservoir, and then we were drilling about a mile-long lateral out from it. So it took roughly 30 days to drill. I'm really, really happy with the overall operations. We're drilling in a high-pressured area. We were starting at a natural fracture that had already produced a bit. So there were some challenging operational parts to it. So I'm thrilled that we got it done on time. And actually, we were able to stay in the reservoir for 97% of the lateral, the mile-long lateral. So, from a operational standpoint, really happy that we were able to steer and stay in those, in that 100-foot area, horizontally or vertically. And then, what was also really encouraging is we saw a lot of elevated mud gas levels, which, are kind of demonstrating whether they're smaller fractures or just the reservoir matrix as a whole. It really helps demonstrate that there are hydrocarbons. It helps us decide where to perforate this lateral and where to complete it. So really encouraging overall, and I'm excited to get to the next step.
Ollie, what do you think next?
Well, luckily there's an RNS system, so we don't have to ask Colin for his 5 bullet points on what he's been up to this year. But I mean, this is kind of a sort of play opening well. Do you think if this is successful, you can go on and repeat it elsewhere in the basin? Is that the plan?
Yeah, absolutely. I mean, we've spent a long time acquiring the acreage out here. We've built up to about 46,000 acres across this play. 25,000 of those are in a federal unit with seismic shot on it. So there's a huge amount of inventory for us. We've also spent time buying up the infrastructure and working so that we can turn this from an exploration and appraisal play into a producing asset, and that's really going to be our focus after getting this well tested. Is turning it into a cash flowing asset, also tying in the other existing wells that are there, including the other one we drilled. So, we've drilled 2 wells here. We have a huge amount that we could do just across our acreage in the Cane Creek Reservoir. And then we've also seen really encouraging signs in the overlying reservoirs here that look very similar to the Cane Creek. So we have opportunity to expand, across our acreage, but also up and down in these reservoir zones.
And this last bit of drilling was fully funded with non-dilutive equity. You've given up a farm in though for that. After
Correct.
your production testing, what have you got to spend money on to get into production? Because a couple of years ago you acquired some gas processing infrastructure to sort of get you ready for this.
Absolutely. Yeah. We've done a lot of that work already, as you point out. We've already acquired the gathering systems across here. We will have to build out the gas processing capabilities, and that's something that we've been in working with a third party provider who has what look like skid mounted units. They get deployed, in modular units, and they'll come out and they'll put together the processing, and we'll pay them a tariff. So we won't be spending capex on that. We'll be we'll be paying them as we put gas through the processing system. So there will be, additional capex as we look at, tying specific wells in, and tying into the main pipeline that goes through our acreage. But overall, a lot of the capex to turn this into a producer has already been spent, and the drilling capex, as you noted, has been spent not just on this well, but on the 16-2 and the 2811.
And I think revenues in the first half of last year were sort of $13 million. Obviously, the oil price has eased off a bit since then. You've got some natural decline, but you are hedged. So should we just be looking at a slightly softer financial second half because of production? And does that hedging really keep your revenues up?
Yeah, I mean, so I don't want to front run any numbers here. We have put a forecast out that says we'll do between 1,100 and 1,300 BOE a day. So we had, you have decline, but we also had some wells come online last year. So we're fairly comfortable with the production numbers. Obviously there are one-off effects like the weather. It's been brutally cold in North Dakota this year. But it was warm enough in Utah that we were able to drill the well correctly. So there's factors that always can work in your favor or not. But overall, you're correct that we have a bunch of hedges in place for the second half of last year. They were favorably priced. I think we were in the around $80 a barrel. So that's going to help the numbers as well.
And are you continuing to hedge into this year as well?
Yes. Yeah. We always look to hedge so that we're protecting the balance sheet and capable of, funding our costs. We continually layer on hedges in an effort to do that. We also try to keep as much exposure to the upside as possible. So it's something we review every month, and we determine how much to put on or to lay off.
I mean, Colin, we discussed last time on the podcast that we talked, that you're a small AIM listed company. London's struggling to really get to grips with it. I mean, you're out there in America. You don't have this lunatic Ed Miliband who is making everybody sort of run a mile from oil and gas stocks. I mean, you've got a great business plan. It's self-funding. Do just be patient and keep going and grow and grow and grow? Is that sort of your long-term plan, or is there something at all different that you're looking at?
I think the most important thing to keep in mind is that the management team has bought 10% of this company over the years. So we're very much aligned with our shareholders. And we always look at things through that, through the lens of what the impact on the valuation will be. So I could see a path where we try to accelerate growth by bringing in a much larger partner into the Paradox and building out that way. I could see a path where we could potentially bring in, sidecar capital, private capital in the U.S. to help us accelerate, and that's what we've done on this well. We brought in an investor who paid $7.5 million to take a 50% interest. We'll certainly look at those options, and we'll also look at public options. But each time we do this, we'll balance what we think is most accretive for our shareholders and for us by extension.
Mm. And so, what exactly? I mean, obviously, at some stage, we'll get results from your drilling, which hopefully will go down well. You have to be careful what you say, so I don't need to say anything like that, about that.
Yep.
But what else, in general, should investors say? Okay, look, actually, in 2025, this company is going to do this, this, and this, and wow, that's why I want to be in the stock.
Yeah, our goal is to triple our production over the next 2 years. A lot of the capital to do that has already been spent in the drilling of the 16-2 and the 36-2. So, for what we think is a low entry price, you can come in and benefit from that capital already being spent and see our production profile grow pretty significantly. I'd love to grow our non-op business as well. I'm cognizant, again, that I want to do this in a way that's most effective for our shareholders. So, we've always been pretty creative in finding partners to help us grow, whether it's been the U.S. government through the grants that we've received, or whether it's direct asset level investment, or our partners with our bank in North Dakota, who have just been wonderful to work with. So, we want to grow the production base, the cash flow base as much as possible. And I see a lot of paths to doing that because there's a huge amount of interest in this industry in the U.S. right now.
I mean, I guess that sort of leads on because the US is getting really interested in the industry. I mean, and again, you sort of can't answer this question, but does one day somebody just go, a US investor just go, this is crazy, the valuation on AIM. Hey, we'll double it and take you out. Could that sort of happen? I mean, or would that suit? I mean, you obviously, as you say, you're big shareholders. Um, is that the way it could go? I'm not asking to trying to put words in your mouth, Colin, but I mean, you are ludicrously undervalued in London at the moment.
Yeah, look, I mean, I think I would revert back to my earlier answer, which is we're always going to do what's in the best interest of our shareholders. So if we see a path with a larger partner where we're bringing them in at an asset level to grow at the Paradox, we would do that. If there's a better path to sell the company outright, we would look at that. So we're not precious about remaining in control of the project if we think there would be a better, larger player to do it. But at the moment, my goal is to invest as much as we can so that we can prove this up and get the best valuation for the project as possible.
I'm very impressed by the way you're keeping your corporate governance so quite clear, Colin. Very good. Oh,
Thanks for trying, though.
Yeah, I know. You got to try. Ollie, you got a final question?
Well, in the run up to the election last year, I think M&A activity started to slow down a bit in the oil and gas sector. How has the sort of sentiment changed in the last couple of months? People looking to get into the sector because of onshoring energy production, or is there uncertainty? How does it look?
No, I think we're still seeing a lot of activity here. That's both broad based. When you see companies like JAPEX who've decided to invest more heavily in the U.S. And speaking specifically about Utah, the Uinta Basin, which is just north of the Paradox, has received a huge amount of interest in M&A activity over the past few years, and the results. I shouldn't even say few years, over the past year. Multi-billion-dollar deals with companies like SM entering the basin, a number of private equity-backed companies that have taken big stakes there. and the results are really encouraging. They're ahead of the paradox with the capital that's been spent and the amount of activity. But we do see, a nice parallel from what's happening there and with what we're doing. So I expect it to continue, and I think the larger companies are running out of inventory in places like the Bakken and the Permian. Prices in the Permian are just extraordinary right now, extraordinarily high. So I would expect more companies to start to step out from those core areas and look at new plays.
Colin, that's a great little chat. So we appreciate you getting on and having a chat with us.
My pleasure. Yeah, happy to
We
do it.
we look forward to those drill results. Could be a bit of excitement, and obviously, if anybody's got any other questions, do get in contact with or get in contact with Colin directly. But many thanks, Colin, for getting on the podcast.
Andrew, thank you so much. Ollie, thanks again, and safe travels to you getting back home.
Thanks.
Take care. Bye.
Hey, well, Ollie, I thought Colin was on pretty good form there, don't you?
Yeah, I did. It was. He's obviously had some, key milestones completed recently. So no surprise that he's upbeat.
Yeah, I mean, we can't speculate on his drill results really, but my instinct, they'll be good. So we'll obviously wait and see. I suppose the real issue here is that, there's the London market still just doesn't really seem to want to reward, dare I say it, success, which is so disappointing. I don't know what the answer is. I mean, it's no better on any other exchange. With a company of this size, America just would have no interest at all. We're actually very lucky in a way that small companies like this, because they can't get any interest in the States, come to London. But you just think, how do you get the reward that he deserves?
Well, I mean, the share price hasn't. It's derated in the last couple of months to the bottom of the recent trading range, and I guess because of what happened with the first well, the market, because of the reasons you're suggesting, but also it's wait and see in case there's some other hiccup. But the potential, if this is successful, is genuinely a transformational play, and it'll take the company from, well, having been extremely profitable in 2022 when oil prices were much higher. It'll really boost the cash flows and enable it to repay some of the debt on the other side of the business, I think.
Yeah, look, it's pretty well positioned. I think that unfortunately, as I say, the market is. We see this with other junior oil and gas. It's not just ones that are based in America. But the nice thing about America is that it's so easy to go and do everything, and you haven't got a crazy Ed Miliband or as many environmentalists. They get it. So in a way, they should trade at a premium to other oil and gas stocks, but they don't. There's just this underlying sort of suspicion, but there shouldn't be. I mean, it's a really good company.
Yeah, so there'll be a few near-term milestones, and hopefully by, I think the last RNS said that the end of March they should have completed their production testing, and hopefully at that point we'll get a bit of a roadmap as to how production might come online and what the forecasts might look like.
Yeah, I mean, with all these stories, they sort of unfold, and what the other thing is, you never know quite what might happen. A year is a very long time in the stock market, and something could happen where suddenly investors go, you know what, we're missing this, we're missing that, and suddenly a wave of money comes along. I'm not saying it will necessarily happen, but sometimes these things happen. It's almost difficult to predict. And suddenly people go, actually, you know what? I want exposure to oil and gas. I get it. This is a good management team. Yes, it's the States, but hey, that's good. And you never know quite when, but suddenly the money comes. So, I mean, really what I suppose I'm trying to say is I think there's plenty of upside here. Not a lot of downside, in truth.
Yeah, and there's plenty of macro factors that could drive that sort of change. Obviously, we saw BP the other day announcing that they want to focus on renewables. That, as well as what's happening with tariffs in between the US and Canada, could have a big impact on the way that investors are looking at oil and gas, not just from a sort of supply and demand side, but from a more sort of, I guess, esoteric angle, and whether the sort of ESG phase that we've had, which has put people off oil and gas, is now shifting and giving way to something more pragmatic.
Yeah, I mean, I think that's right. By the way, I'm out in Canada at the moment as we record this, and I don't think Canada's about to become whatever it is, the 53rd state of America.
Well, got to get through the ice hockey team first.
Anyway, there we go. But yeah, look, I thought Colin was on really good form. It is an interesting situation. There's a lot of value there, and there's actually not a lot of risk, which is what I quite like. But we just need the market to recognise it. I think that's a pretty good summary, isn't it?
Yeah, absolutely.
All right, very good, Ollie. We better go and find another good oil and gas company to do a podcast with.
All right, speak soon.
All right, thanks.
This podcast has been produced and edited by VSA Capital. It is intended for information purposes and not as investment advice. The information is intended for recipients who understand the risks associated with equity investments in smaller companies. Please do your own research and do not rely on a single source when making an investment decision. VSA Capital may derive fees from this content and seeks to do business with the companies mentioned.